Hello and welcome to Portfolio Matters Weekly Update Week 92. But before we get into it, Richard will read the disclaimer.
Thank you very much, Keith. I'm sorry to everyone, I'm slightly hoarse today, and bear with me. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Keith, what have we got this week?
Well, it was a busy week. So, most importantly, we had the Federal Reserve meeting, and the Fed raised rates by the expected 0.75% to 3.75 to 4%. However, afterwards, Jerome Powell gave a press conference in which he stated that he expected rates to rise further than previously anticipated, although they would get there more slowly. And the market took that badly, and there was a sell-off in the S&P 500. Then on Thursday, we had the Bank of England meeting, and the Bank of England also raised rates by 0.75% to 3%. But the Bank of England differed from the Fed in that it stated that it didn't expect to see UK rates rise much further and warned of a prolonged recession in the UK lasting until 2024, and sterling fell on that news. The Bank of England also did QT this week, selling 750 million of short-term gilts, and that seemed to go okay. Elsewhere, we had Russia at the start of the week pulled out of the agreement to allow Ukrainian grain shipments through the Black Sea, although by the end of the week, it had reversed that policy. And finally, Indonesia, which is a big nickel exporter, is attempting to instigate an OPEC-style cartel for battery metals. And so high commodity prices are causing this shift in power towards producers, and they are attempting to exploit that. So some charts relating to the news. Well, this is market expectations of peak Fed funds rate, and you can see it's hit a new high and still rising. And this is the action in the S&P 500 following the FOMC meeting. So on the expected 0.75% rise, the S&P rose, but then when it digested Jerome Powell's comments in the press conference afterwards, it fell sharply. And the Bank of England has commenced QT. So the orange line here is the path for the Bank of England's balance sheet if it goes ahead with active sales, as well as allowing gilts to mature. However, the sale of only 750 million, that's tiny compared to its balance sheet of 880 billion. And as we've discussed before, when they did QE, they assumed and they proclaimed that this was not money printing and it was reversible. Actually, it's proving to be very difficult to reverse. So that means they're unlikely to be able to fully reverse it, and it has amounted to money printing. This is Ukrainian wheat exports. Now, by the end of the week, Russia has rejoined the agreement to allow grain shipments, and you can see that grain shipments have been recovering, although they remain well below their pre-war levels. And the reason Russia has rejoined the agreement is that earlier in the week, when they pulled out, Turkey continued to escort grain shipments through the Black Sea. So either Russia was going to have to get into conflict with Turkey, or they're going to have to back down, and they're back down. Okay, on to this week's economic data. So we had the EU inflation numbers, and they came in hot. CPI inflation in September was 9.9%. It was expected to rise to 10.4%. It rose to 10.7%, a substantial rise on September and well above expectations. Core was 4.8% in September, rose to 5% in October, again above expectations. UK interest rates rose as expected by 0.75% to 3%. And we had a couple of figures from China. We had the Caixin Services PMI, and that missed expectations, falling from 49.3 to 48.4 in October. So that is in contraction territory. The Chinese economy is not doing well. And the composite beat expectations, but again was below 50. And then we've had a load of US data, most notably the full ISM survey, which I'm going to go through. So first of all, the Fed met and it raised interest rates by 0.75% to between 3.75 and 4%. We then had the ISM non-manufacturing and manufacturing PMIs. Now, you remember that last week we had the S&P Global manufacturing and non-manufacturing PMIs in the US, and those were all below 50. So there's a difference between the ISM, which is portraying a much healthier US economy, than the S&P. So the headline non-manufacturing PMI slightly missed expectations, was down from 56.7 to 54.4 in October, but that is still in expansion territory. Reminder, the S&P Global number was below 50. Employment in the non-manufacturing sector also deteriorated and fell to below 50, and that is big miss. New orders fell, but remains quite strong at 56.5. Now, the most interesting piece of data from the non-manufacturing was the fact that prices paid bounced, rising from 68.7 to 70.7. That is in direct contradiction to a lot of data we've seen. It's showing that pricing pressures remain elevated for the services sector. We move on to the manufacturing sector. That slowed from 50.9 in September to 50.2 in October. So the manufacturing sector is not doing as well as the services sector. New orders bounced but remained below 50, so we're in contraction territory. And manufacturing prices fell sharply. They're 51.7 in September, 46.6 in October. So manufacturers are seeing a sharp drop in pricing pressures. The non-manufacturing sector is seeing continued pricing pressures. And then the other big news of the week was we had the JOLTS job openings, and they unexpectedly rose sharply. So in September, there were 10.3 million job openings. That rose to 10.7 in October. So the US jobs market remains tight. Although the Challenger job cuts, reminder, these are announced job losses from US corporations, rose from 30,000 in September to 34,000 in October. We also had some quarterly data. So European GDP growth disappointed. It fell to 2.1% year on year in Q3, and the quarter on quarter growth fell to 0.2%. Both of those missed expectations. In the US, we also had labor costs, and those were reassuring, falling to 3.5% annualized in Q3. And that is great news in the fight against inflation. It shows that wage pressures are dropping. So Richard's having problems with his throat today, so I will do the charts. So this is the EU inflation rate, and frankly, that is a frightening chart. That is heading to the moon and shows absolutely no sign of coming down. This is the core inflation chart, similar. EU year-on-year GDP growth is fading, and the EU is very likely to be in recession already. Quarter-on-quarter growth looks even worse. UK interest rate, now that is rising at a very fast rate. And when interest rates rise quickly, something breaks, particularly when there's a lot of debt in the system, and we've got a lot of debt in the system. This is the Fed funds rate, and the same is true there. Now, this is the ISM manufacturing PMI, and it's above 50 still, but it's fading fast. Employment had a bit of a bounce, which kind of contradicts the PMI. New orders below 50, but it bounced. Prices paid have collapsed. That's great news for the fight against inflation. We then move to services. Services are much stronger than manufacturing, but again, fading. Employment actually dropped to below 50 in October. So that all these numbers actually seem to contradict the JOLTS job openings. New orders well above 50, but fading. So the JOLTS job openings bounced, and that portrays a labour market that remains very tight. Although the quit rate dropped slightly, but still remains very high. So US workers are still quitting their jobs to find better paid alternative jobs. And these are the challenger job cuts, and those are rising but not elevated. The US 30-year mortgage rate remains above 7%, but has not risen further this week. It has more than doubled in the past year, and that is very bad for the US housing market. Initial jobless claims, stable. Continuing jobless claims, is that the early signs of a sustained rise? Something to watch in subsequent weeks. So this is the Caixin Services PMI, and that does not look healthy. We'll have to see what China does about its COVID lockdown policy. Last night, there was quite a large bounce in the Hang Seng on mere rumors that there might be an end to it. And the Caixin Composite PMI is also below 50.
Can I just thank you very much for doing those on my behalf, Keith. The thing that really worries me actually is the vast quantities of fixed rate interest instruments that are out there that have a counterparty that is hugely exposed. And I suspect that I wouldn't be surprised, I should say, that if that were where the sort of instability of the financial system is exposed.
Yeah, that's a very good point. Lots of people have fixed rate mortgages. Who's on the other side? Because they're losing a lot of money. So in summary, European inflation continues to rise and shows absolutely no signs of peaking as yet. The European economy is probably already in recession. The US labor market remains tight, and that means inflation will probably be persistent, although wage growth has slowed in the past quarter to below the current inflation rate in the US. So US living standards are falling. But the US economy continues to show resilience according to the ISM surveys, with the service sector still expanding, although the rate of expansion is falling. The Chinese economy is weak. And onto one chart. Now, this is the path of inflation between the period 1974 and 1984. Now, this is one of those dodgy charts where we try and correlate current experience with experience in the past. But I think our experience of inflation is likely to be similar to the periods 74, 84, in that I expect a double top. Because we're now raising rates very fast, and that will kill the economy. And recessions cause a drop in inflation because you create lots of unemployment. Therefore, wage inflation drops and inflation drops back down. And we've previously shown you tables showing that in every recession, there is a sharp drop in inflation. But the underlying causes of inflation this time, i.e. a tight labor market and very tight commodity supplies, have not been fixed. In particular, there's good reason to expect the oil market to be even tighter next time. And so as we come out of recession in a couple of years' time, I expect inflationary pressures to rebuild very quickly. And so I think as soon as we get economic expansion back, we also get inflation back. Richard, any thoughts?
Yeah, I agree with you, Keith. I also think that it's interesting that the central bankers are finally adjusting their inflation expectations for inflation to remain high and tail off at a much more shallow rate than initially they were saying. And so they're slowly adjusting to the current environment. I guess my concern is that if I think the financial system is vulnerable, and if something goes seriously wrong with it and they start QE again to try and save it, then all bets are off as far as inflation is concerned. But in a sense, there's so much excess in the system that it has to unwind somehow.
Yeah. Okay. So on to Inflation Watch. And new policy, new data is highlighted in bold. So in the UK and the US, we have had interest rate rises this week. In the UK to 3%, in the US to 3.75 to 4%. We've also had EU inflation data, all of which came in hot, as we previously reported. In Japan, we also had inflation data for September, and that is high. That's coming in at 3%. Now, we have a section on Japan coming up, but for how much longer can Japan keep on attempting to suppress 10-year rates at 0.25% when their inflation rate is 3%? So this is the Bank of England's commodity chart, and they persist in saying that inflation is going to fall back towards target in 2 years' time, as they always do, and so far they're being consistently wrong. Perhaps at some stage they'll be right. Now, this is Goldman Sachs US inflation forecast, and you see that their forecast for core inflation is down from earlier in the year, and they're forecasting it to fade towards 2% towards the end of the next year. And adding to disinflationary pressures, this chart shows the world inflation rate in green and world PMI prices paid and delivery times are showing that goods price inflation is fading. And hopefully that should mean that inflation, world inflation, should come down in due course.
It's interesting. If you look at that chart, Keith, the inflation rate is normally inside, i.e. showing less strongly than the world price pressure.
Yeah.
But at 2022, it is stronger than world price pressure.
Yeah. That's because we printed loads of money. Now, there is a big difference developing between European and US inflation. And Europe is suffering from very high energy costs, which the US is not. And so we're seeing this divergence, which we will discuss.
And also the American banks, I think the big American banks have stronger balance sheets on average than the European banks, which means that they are less vulnerable to the vicissitudes of the economy.
So that means they can continue lending, whereas European banks are going to have to pull back as the economy slows. That's a very good point. In fact, they'll probably need to raise capital.
Thank you for enumerating my point there, Keith. You did it very well.
Yes. Now, this is wage inflation in the US, which remains above the Fed target, although you see the quarterly data was more reassuring than that. And this was a tweet by Larry Summers, the former US Treasury Secretary, showing that 80% of CPI components are rising faster than 5%. And he was saying the Fed needs to keep on raising rates and keeping rates high to squash inflation. And that is exactly what they're doing. But you see that US money supply is now shrinking. And I think disinflationary pressures are building. I expect to see US inflation peak, just like Goldman Sachs are saying, in the next few months. And US CPI appears to have decisively peaked back in June. And you see the contrast between US inflation, which has very much peaked, and European inflation, which is rising quickly. History tends to show that when US CPI has peaked, core CPI peaks between 2 and 6 months afterwards. And reminder, the Fed is more interested in core CPI. So we should see a peak in US core CPI inflation around the end of the year. But a problem for the Fed, and why US inflation is different from European inflation, is that the US government overdid it during the pandemic, and there's still a lot of excess savings in the system in the US that is supporting consumer spending and supporting demand. And you can see that better on this chart. So there was $2.2 trillion of excess saving during the pandemic. And since then, we've had 0.7 trillion of dissaving, which means there's still 1.5 trillion of excess saving as of the end of September. But the savings rate is now well below normal. It's at 3.1%. And a lot of US consumers are turning to their credit cards. And that is an indication that that saving has been very unequal. People at the bottom end of the income spectrum are now turning to their credit cards to make ends meet, as the cost of living crisis also affects the US. So in summary, the US and Europe are having very different inflation. Europe is suffering from cost push inflation. We're having an energy shock, which will have a broad knock-on effect throughout the supply chain. And those effects, I don't think we've fully seen yet. You've seen that BASF, for example, have closed down a lot of their European manufacturing. We've seen lots of nickel smelters in Europe and aluminium smelters closed down permanently. We are going to see a broad and long-lasting cost push shock in Europe. In the US, where they're energy independent, they're having demand pull inflation because they overdid the pandemic stimulus, and US consumers still have a lot of cash. So the US has this inflationary impulse that is passing through the system, and they're raising interest rates to kill the economy, and that will kill inflation. In Europe, we're having cost push inflation. And so you'd expect that to last longer and to have a longer term impact. So the investment implications of that are that longer term, the US economy is in a better place than the European economy. And that could mean that the US dollar continues to strengthen. Richard, any thoughts?
It's interesting, isn't it, Keith, that the two mechanisms of inflation are different, but they're coincident.
Yeah.
It does look from the data that America has started to bring its inflation under control, whereas Europe is undoubtedly not got it under control yet.
Yes.
So that they are in very different places. One of the rationales for Europe is it wants to set up, it wants to be a competing economic entity to match the US, doesn't it? And unfortunately, the circumstances it now finds itself in, it's very much a junior, financially, it's very much weaker than the US and in really quite a difficult position.
Yeah. Okay, on to recession watch. Now, this is the US yield curve, and traditionally the best indicator with 100% track record is the 10-year minus 3 month, and that has inverted. So it is now forecasting a recession. And as you can see, historically, the vertical gray bars are recessions, and it has 100% track record, although it can be early. So it's forecasting recession within the next 6 months to a year. Now, in Europe, the cost of living crisis is biting, and you're seeing that US consumers are cutting back, particularly on big purchases. So this is the balance of European consumers who are intending to make major purchases in the next year. You see it's at minus 40. We look at car sales in Europe. This is a depressing chart. So car sales are 40% lower than they were pre-pandemic. European consumers are suffering from a big inflation hit. So if you look at the value of goods bought, which is the blue line, they have risen, continue to rise, but that's an effect of inflation. Actually, the quantity of goods bought is falling. And the Bank of England is forecasting that the UK will have a long, shallow recession. Although I don't really see how that forecast is compatible with its own forecasts of a doubling in the unemployment rate. That doesn't look like a shallow recession to me. And returning to the Bank of England's commodity charts, so this is its own forecast for its base rate. And the dark red line was August. So when's that? 2 months ago? You'll see, it's continually gets this wrong. I just don't believe it.
It's a bizarre world, isn't it? But they don't refer to the fact they've continually got it wrong, and everybody takes their pronouncements absolutely seriously, or appears to do so. Or the media does at any rate. And I actually think forecasting inflation is extremely difficult.
Yeah.
I really do think it's extremely difficult, and they probably shouldn't come out with these forecasts that are totally spurious. They should just say it's jolly hard.
Yeah, well, I don't think they're going to go above 5%, frankly. I don't think they're going to get there.
From a political point of view, you mean? I mean, political with a small p.
We've said, and Andrew Bailey has stated, he didn't expect rate rises to go much higher. So what's this chart? Why is it saying it's going to go above 5%? This is from the FT today, and they're using Bank of England data.
Yeah.
Andrew Bailey said one thing. This is saying another thing. I just don't, there's something wrong here.
Also, I mean, interest rates will go where they need to go to contain inflation.
Well, I mean, the thing is, European inflation is persistent and rising, but we know that these high rates are killing everyone, killing mortgage holders, and I think the high rates will just kill the economy, really, with a lag, but very effectively. Yeah, and so I just don't think they can go much higher.
Yeah. I mean, it's the only thing, and I don't know enough about this. Keith, you know a great deal more about it than I do. But if you look at economies that have seriously high inflation for prolonged periods of time, how do they differ from the circumstances that, let's say, UK or Europe now finds itself in?
Well, the ones that continue to have high inflation don't raise rates, essentially. So if you look at Turkey, Turkey has cut rates in the face of rising inflation. And that basically encourages everyone to borrow money because the real rate has gone very strongly negative.
Yeah.
And that just increases the money supply and you get runaway inflation. That's exactly what's happened. Here you have the opposite. You're raising rates. And that means that borrowers, and we have a lot of debt in the system, are now paying a lot of money on interest, which means they've got less discretionary spending power. So that just sucks money out of the economy and sends it into recession, and that kills inflation.
And then we do end up potentially with a vicious spiral of a big economic downturn, a reduction in government tax takes, inability to service the debt.
Yeah, that's true. That is true. And I know we've got the budget coming up.
Yeah.
And, we already have a fiscal hole, and slowing the economy is not going to improve that. Because as Richard says, you reduce your tax take and increase your expenditure on welfare.
Yeah, increasing the fiscal deficit.
Yeah. Talking about the effect of high interest rates, this is a pretty frightening chart for UK mortgage holders. This is the change in the 2-year and 5-year mortgage rates this year. So this is from the BBC. If you look at the light bluey green bar, that is the mortgage rates at the end of last year. And so the 2-year was then at around 2.4%. It's now the best part of 6.5%. Mortgage holders are going to face a big rise in their interest payments as their fixed term deals roll off, as we have discussed previously. And UK bankruptcies are at a 10-year high, although they were artificially suppressed during the pandemic. But that's only going to get worse. And this is data from the US, but European and UK consumers will face exactly the same problems. So high inflation in staples, such as food, energy, mean that consumers have less discretionary spending power. So service sectors such as restaurants are going to suffer. Talking about rising mortgage rates, but in the US, we saw earlier that mortgage rates were above 7%, and that is causing a collapse in house sales in the US. And purchases of second homes have collapsed by 70% this year. So, reminder, the housing cycle is the business cycle. The housing market is slowing in the US, and that will mean the economy will slow with a lag. So in summary, UK and European economies are already probably in recession, and that recession is likely to be long-lasting. And frankly, I disagree with the Bank of England. I think it's going to be bad. in Europe, the PMIs are the same as during the GFC. So you could see a very bad recession in Europe. In the US, the housing market is slowing fast, and we expect the US economy to follow. Okay, on to the energy crisis.
Do we have something positive to talk about, Keith?
No, we don't.
It's very sad, isn't it? It really is, actually.
Yeah.
It's very sad indeed.
So this is German power prices, and having fallen over the last few weeks, they've had a bit of a bounce this week as cold weather has set in. UK gas futures have bounced hard. So they are up the best part of 50% in the last week. And the European energy crisis has started really well because we had the warmest October in Germany since record began 140 years ago. So hence, gas demand was much lower than normal. And that means that storage capacity is full. So this is the temperatures in Frankfurt, Germany, and that is the deviation from normal. You can see it's been very warm. So that meant that lower gas demand and gas prices fell, and storage rates are very good. So here we are relative to history, and we are still building, although the size of the build is now declining as winter gas demand starts to build up. Now, whether we get through the winter depends on how big the drawdowns get, how cold it gets. And if we look at futures for electricity in Europe, the market is still expecting very elevated electricity prices later in the winter, with the worst being France at over €1,000 per megawatt. UK is next at 800. Switzerland, Netherlands, Austria, Germany, Italy, Nordics. Nordics have a lot of hydroelectric. But looking forward beyond the end of this winter, this energy crisis is going to last a long time because we need to build the infrastructure to get LNG, alternative LNG supplies into Europe. So this is from Bank of America, and they are forecasting that gas flows into Europe will not have returned to their pre-war levels by 2025. And that suggests gas prices will remain elevated until at least 2025. So in summary, the energy crisis in Europe has started well because of mild weather. How bad it gets really depends on the weather. But Richard, you wanted some good news. I thought this was quite good. So according to Russian media, the Finns are suffering because they're very dependent on Russian gas flows. But, I think the Finns are very good at coping with cold weather. Now, on to COVID Watch. Richard, is your voice up to this?
Yes, thank you, Keith. I'll give it a go. So is the pandemic over? Well, this chart looks at deaths, and we know, don't we, that deaths are much lower than they were. Just sort of anecdotally, the hospitals aren't full, etc. And obviously the impact of the vaccination and the booster program is highly effective. I had my booster and I went down with COVID 3 days later. So my booster was a waste of time. I had it too late. And then this is US data, daily confirmed cases per million people, which is actually very low, or very low comparatively. And I think in the UK at the moment, we've got something like 1 in 70 people are reputedly have COVID, don't they, Keith?
Something like that. But then, Richard, when you had COVID, did you report it to the authorities? No. See, I'm anecdotally, a lot of people I know have had COVID, and I don't think any of them are reporting it. So, how accurate is this data?
Yeah, they must extrapolate from something, but precisely. This is UK case. It actually looks very similar to the US graph, as Keith rightly points out. There's a huge amount of underreporting. Presumably, they take that into account when they prepare these stats, but we don't know how they do that. So there's a lot of uncertainty about it. I think, and France has they've all got a similar rough outline to them, although they've got their idiosyncratic spikes and so forth.
Yeah.
And I think the problem that China, as Keith rolls through these graphs, the problem that China has is that it still hasn't got an effective vaccine, and therefore the death rate per case is much higher. The severe illness per case is much higher, and that's a dangerous situation that China has got itself into. So this is quite interesting. Lockdowns had little effect on COVID mortality, but they make a very vocal and politically active minority feel safer. Absolutely. I mean, my personal position on lockdowns was the first one was probably a sensible and reasonable thing to do because we didn't know what we were dealing with. But subsequent lockdowns were wrong and we shouldn't have had them. I also think we're now seeing there's an outcome with young school children, 3, 4 or 5-year-olds, not socializing so well, poorer language skills, because they were stopped from socializing at a critical time when their brains were developing. And I suspect we're going to see young children growing up with difficulty interpreting facial expressions because they're exposed to an absence of facial expression via mask wearing. That's a personal view. I don't think there's any evidence out there for it yet, but I wouldn't be in the least bit surprised. I think we're probably inflicting significant damage on our very young children.
Well, my son's school, I hadn't realized this until early in the week, but about 30% of his class have irregular attendance.
Really?
Yeah. And there was an article in the FT talking about this in general, that COVID has had a big effect on children, many of whom don't feel comfortable going back to school.
And of course, we were under the illusion 12 months ago nearly that we were out of COVID free and clear. We'd somehow economically survived the huge hit. And of course, what everybody is seeing, not just the UK, one of the consequences of the losses to the economy that were funded by government spending is now coming out of the system now, and will continue to do so for a long time. So there's no such thing as a free lunch economically.
Yeah. I remember what happened last time, Radio 4 hysterically calling for further lockdowns.
Absolutely. I mean, it was never why are you locking down, it was why aren't you locking down harder. There's an extraordinary bias in certain sections of the media.
Yes.
And just this assumption that if you weren't locking down, then you were mad. Noticeably, actually, it came from the public sector, not the private sector.
Well, I don't think we can afford it this time. So, So anyway, let's hope this is the last COVID watch we have to do, but we've done it a few times now. So,
Can I just add that I have had my flu jab. I had it several weeks ago, and I'm confident that I'm not going to come down with flu.
Yeah.
Famous last words.
Yeah. You sound great on it, Richard.
Doing me worlds of good, Keith.
Okay, on to the UK labour force. And actually, this is good news. So previously, we did a section on how UK labour force was sick and how there'd been a rise in long-term sickness. And that was the reason that people were leaving the labour force. And one of the reasons the labour force was so tight, which was causing inflation. Well, further work has been done. And that narrative is now not thought to be true. Yes, there has been a rise in long-term sickness in the UK, but it is concentrated in people who have already left the labor force. And so actually, the new evidence is the main cause of labor market tightness is people voluntarily leaving the workforce. And that's better news because they could voluntarily come back. So this chart shows changes to the workforce pre-pandemic, which is in light blue, and post-pandemic. You see that pre-pandemic, people were joining the workforce. So in particular, the over 50s were joining in large numbers, and they were the main cohort adding to the employment statistics. Now, post-pandemic, that's reversed. Post-pandemic, a lot of over 50s have decided actually they quite like not working and decided to leave the workforce. Now, how much of that has been facilitated by high asset prices, which are now reversing? And the good news is they haven't left the workforce because of ill health. They've chosen to leave the workforce, and so they could rejoin, which would be good for the employment stats, which is good for GDP growth, inflation, etc., etc. Okay, but that's the extent of the good news, I'm afraid, this week. So let's move on to diesel. Now, the world is facing a diesel supply crunch, as we've discussed in previous weeks. And this is US diesel inventories. And you'll see that we're now down to 25 days of supply, which is the lowest since the depths of the great financial crisis. Diesel supplies are tight, and stocks are now well below their 5-year average, and they have fallen consistently over the last year, although the last couple of weeks they've been flat, so they haven't been falling the last couple of weeks. And they're at the very bottom of their 10-year range. And as we've seen, they only cover around 30 days of US consumption. And all that means there's a very big crack spread. Now, reminder, the crack spread is the difference between the price of a barrel of oil and the price of its processed products. And the crack spread shows how much refiners make. And refiners are making out like bandits at the moment because of the lack of refinery capacity. And you can see that in UK fuel prices. And this is from the RAC as of the 31st of October. And you see that diesel is trading at a 15% premium to unleaded. And all that is because we have lost Russian diesel supplies. Now, as sanctions become more effective, Russia is having to find new markets for its diesel. And that mainly involves either sending them to Asia and China, and that means they have to go by sea, and that's a slow process, so the flow is reduced, or they're going to the Middle East, where Middle Eastern producers are either blending it with their own and re-exporting it, or they are using Russian diesel and exporting their own supplies. In summary, there is a global shortage of diesel due to sanctions against Russia, which may well cause severe shortages in the coming months because inventories are low and still falling, and building new refining capacity will take years. So this is not a short-term problem. Onto the wealth effect. Now, last week, we showed you this table, which showed that the drawdowns in asset markets had caused a 54% drop in US household wealth as a percentage of GDP. And that was much bigger than in the early 80s when Volcker raised interest rates hard. And the implication of that was that because people tend to spend a small portion of any increase in wealth, this time, as they were losing a lot of wealth, they would cut back on their expenditure. But, and thank you to Wayne J on our Discord for this, you'll notice that this table is as a percentage of GDP, not as a percentage of wealth. And that matters because total wealth increased very substantially during the pandemic when there were zero interest rates and all asset prices shot through the roof. So although US household wealth has fallen by around 50% of GDP, during the pandemic, it rose by 100% of GDP. And so actually, US households are still wealthier than they were pre-pandemic or actually even a year ago.
If we just go back to that previous chart, Keith.
This one.
The one before. So the interesting thing is, so the pandemic is hugely destructive for the economy. We know that, the economy took a real hit. So you would think that the graph would actually go the other way. So at the time where it spikes up, it actually should have spiked down household wealth. So what was created was wealth in inverted commas. And where we are now is that wealth in inverted commas needs to disappear, and that chart needs to go back down to where it would have been if these numbers had truly reflected the hit that the economy took from the pandemic. Which means, to my way of looking at it, it probably needs to drop from where it is now 5.5 down to around about between 4 and 4.5, and that would mean it's got another 30% to go.
That is a very good point, Richard. Yeah, good summary. I think Richard makes a very good point there. But right now, the loss in wealth has not been enough, I would say, to curtail US household expenditure because US households are still feeling richer. But if it falls further from here, the wealth effect may well start to curtail household expenditure. Okay, now this weekend, I will be recording the much delayed Beginner's Guide to Bonds. And thank you very much to members of our Discord, in particular Wayne J, for their feedback in putting that together. Now, in doing that, Wayne sent me a really interesting piece on government defaults on local currency bonds. Now, I have previously thought and previously stated on this podcast that governments don't tend to default on their bonds in local currencies because they can always just print the money to pay off their debts. That turns out not to be true. So, in the last 25 years, all these countries have defaulted on their local currency bonds. Venezuela in 98, Russia in 98, Ukraine in 98, Ecuador in 99, Argentina, Jamaica twice in 2010 and 2013. Because inflation also has economic and political costs, and also inflation is only effective in eroding the real value of your debts if you have lots of long-term debt, and if you have short-term debts or index-linked debts, is not very effective at all. In particular, if you have short-term debts, then those need to be refinanced quite quickly. And as inflation rises, you simply need to refinance them at higher and higher interest rates. So inflation doesn't work as a method for reducing your debt burden. And so debt restructuring is actually often the more palatable choice. So the investment implications of that are just be wary of heavily indebted sovereigns. They will default on both their external and their internal debt if they have to. Okay, now finally this week, this has been on Twitter, the Japanese yen doom loop. The story goes, Japan is limiting the yield on its 10-year JGBs to 0.25%, and it is printing money in unlimited size to do that. In the meantime, US Treasuries are yielding over 4%. So Japanese investors are selling yen to buy US dollar assets. That drives the yen down. The Bank of Japan then has to sell US Treasuries to support the yen and to stop the yen from falling too far. The sales of US Treasuries by the Bank of Japan drive up the yield on US Treasuries, which then incentivizes further sales of yen by private investors in Japan, and a doom loop ensues. So this is from Twitter. Weak yen equals sales of US Treasuries by the Bank of Japan, which means higher interest rates, which means that Japanese investors sell the yen to buy dollars, etc., etc. And this is the Japanese 10-year bond yield over time, and you'll see they are now defending it at 0.25%, and it has not risen above that level. And they are committed to unlimited amounts of QE to defend that. But I thought this is a fantastic chart. It's not working. So this is the Japanese yield curve. And you'll see they are defending the 10-year. And there's this drop in the yield curve at exactly 10 years. If you move to 3 months either side, the yields are much higher. And it just goes to show, interventions in capital markets have limited effect, because essentially the market is very powerful. It can swamp the action of the Bank of Japan.
The thing I think is very interesting about the Japanese situation is that, clearly they've had no inflation or deflation or disinflation for many years, and that's, I think, primarily as a consequence of the balance sheet recession that they've had. In other words, corporate and banking balance sheet were bloated with debt 25, 30 years ago. And as those debt levels have come down, they've effectively had a slowing of the economy for a protracted period of time. But the Japanese central bank seems to be predicating all those arguments on the fact that inflation is going to stay low. And we know that was wrong in the UK, it was wrong in Europe, and it's wrong in America. What happens when it's wrong in Japan?
Well, I go back to your point, Richard, about markets being complex, non-linear systems. See, if Japanese consumers finally start to think, well, actually, they've printed a load of money, inflation's now 4%, bond yields 0.25%, saving all this money is just pointless. Yeah. I need to get it out of yen and move it into gold, US dollars, whatever. Yeah. Then, you precipitate a crisis.
And I think I think sort of short-term manipulation and interference in the markets is fine. Bank of England did a short-term interference in inverted commas in the markets a few weeks ago, and that was necessary and an appropriate thing for them to do. But these sort of interference in the markets for many, many years causes such enormous distortions.
Yeah, it's difficult to see how they can renormalize without big problems.
Yeah,
we'll get on to that. So this is the Bank of Japan intervening within FX markets to try and slow the yen's rise. So in both these points here, they have intervened when the yen crosses a big number. So here it was above 145 yen to the dollar. Here it was above 150. In both cases, they sold their US Treasury holdings to buy yen. And you can see here they have indeed been net sellers of US Treasuries over the last year. And Japan is the largest foreign holder of US Treasuries. But it's still got lots of treasuries left. So this is the FX reserves of Japan, and it has 1.2 trillion left. So its interventions in October, which cost it 43 billion, are really not very substantial. Japan is suffering from a structural trade deficit currently, and so it will also be selling US dollars to fund its trade deficit. So part of the narrative of the yen doom loop is that the Bank of Japan is printing yen in unlimited quantities to stop the 10-year from rising above 0.25%. Well, actually, that's not true, because the Bank of Japan's balance sheet is shrinking, which is not what I was expecting. And if you look at its month-on-month change in assets, actually, it's been shrinking fast over the last 4 months. Now, what is happening is that its COVID loan book is expiring. And so that is the main reason its balance sheet shrinking. If you look at its purchases of government securities, well, actually, it is buying the 10-year in unlimited quantity, but it's effectively bought pretty much all of it. So it doesn't have to do much buying. But speculators are very short the yen. Okay, so on the doom loop, I think the doom loop is silly, essentially. Official sales of US treasuries have been very small in size compared to the size of the US Treasury market. And if that narrative ignores the fact that Japanese investors have been buying US Treasuries. So part of this doom loop narrative is that the official sector in Japan is selling treasuries, and the falling yen and low Japanese interest rates were incentivizing Japanese private individuals and corporations to buy treasuries, and that is not accounted for in the narrative. So net, there's actually been only a small decrease in Japanese holdings of treasuries. But what is more interesting is that we've turned to this chart. Japanese attempts to fix the yield curve are failing, and the yen is falling. Will at some stage the Bank of Japan give up on its attempts at yield control, which are patently not working? When they do, that could cause a big rise in the yen. And you can see from this chart that hedge funds and speculators are very short the yen, and that would cause big losses. Something to watch out for. I wouldn't be short the yen at this point, actually. Richard, you're mute.
So Keith will be giving an update on to when he thinks we should all go long the yen.
Yeah. You might be waiting a long time, actually.
Very interesting, Keith. I like your assessment of the doom loop. I think you're right, and it's very easy, and I'm probably as guilty of this as anyone. It's very easy to draw simplistic conclusions in an economic context where there are actually multiple factors that one probably isn't aware of that are also influencing the outcome, which is, of course, what makes it A, so fascinating, and B, so difficult to predict what's going to happen.
Except, actually, that wasn't the end. We're quickly going to go through food prices. Now, I prepared this earlier in the week when Russia had pulled out of the agreement to allow grain supplies to the Black Sea. But we haven't actually looked at food prices in a while, so we'll do a quick survey. Okay, so this is the UN FAO food price index, and that has actually fallen steadily over the last 6 months. And that has been mainly driven by the fall in vegetable oil prices. Going through charts. So this is corn, and that actually remains elevated. This is rapeseed oil, and it's come off its peak, but seems to be bouncing. Coffee down. Oats well down from their peak, but seems to have found a bottom. Palm oil bouncing back up. You notice that oil prices are rising. Palm oil can be used in biodiesel. Rice rising steadily. Soybeans down from its peak, but seems to be bouncing. Sugar never really participated in the boom. Wheat, that looks like a steady rise to me. So this agreement to allow grain shipments through the Black Sea looks fragile. If there's a suspension of grain shipments, then they're likely to rise further. And looking through those individual charts, it would seem to me that the recent falls in the food index may have ended.
Also, again, very difficult to predict, but the price of fertilizer, I don't know whether it has stabilized, but the massive rise in fertilizer prices is going to affect next year's harvests, undoubtedly, because farmers will be less able to afford fertilizer.
Yes, agreed. Yeah, that will affect crop yields with a lag. Okay, moving on to other charts. Now, piece of good news post-Brexit. This is FX trading volumes by location. And you see that actually London continues to dominate FX trading. So that is one thing that hasn't got worse post-Brexit. I thought this was an interesting chart. This is global sales of junk bonds, which have collapsed this year, which means that corporations with poor credit ratings are finding it very difficult to refinance their debt, and they can only hold off from returning to the market for a period until their existing loans refinance. So then they're going to be facing a big increase in their financing costs, and you could see a big rise in bankruptcies. So right now we're in a phony period where they still have their very cheap financing from the pandemic period. And this is the increase in European government debt during the pandemic. Big increases. This is the interest paid on US federal debt, and that is 700 billion a year.
That's extraordinary, isn't it?
Yeah, rising sharply. So the costs of all the pandemic largesse are really now starting to bite as interest rates rise. So money isn't free after all. And on to good news, and we need some. This is great. So this is global poverty since 1820. And actually, you'll see that over the last 50 years, the number of people living on below $2 a day has absolutely collapsed.
Is this inflation adjusted, Keith? Oh, it is.
It is, yeah, adjusted for inflation. So this is real living standards. And, you know, everyone in the UK is up here. But total real poverty has collapsed, which is great news. Capitalism works, although we are burning through the world's resources at a pace. Sorry, that was meant to be good news. I'll cut that comment.
There's always a kicker, isn't there?
Yeah, that's right. Okay, and on to the checklist. So, UK and Europe really bucked the trend this week and the UK market had a good week. Now, we know previously that the UK market is very undervalued relative to the rest of the world, and that developed post-Brexit. So maybe the new government is leading to a reappraisal of the UK as an investment destination, and capital is returning to the UK, which would be great news. So the all share was up 3%. The stocks Europe was up 1.5%. The S&P had a bad week, down 2.3%. It sold off hard after the FOMC meeting. NASDAQ was down 4%. Now, Hang Seng, having had a bad couple of weeks, bounced hard overnight in particular, was up 8.8% on the week. Largely, it seems, on rumors that there will be an end to the zero COVID policy. Japan Topics Index was up 0.8%. Bitcoin is up 2.2%, down 55% on the year. The dollar index rose by 1.5%, so both sterling and the euro had a poor week. And this is the dollar index. And so a few weeks ago, it looked like it might be coming off. Well, it's bounced back and looks very much on trend. And this is the CNN Fear and Greed Index. And having been in greed for the last couple of weeks, it's fading a bit towards neutral. And this, if you want to know what time to start thinking about investing in equities, this is a really good chart. And basically, all it says is, don't even think about it until the Fed has stopped raising rates. And then you might want to think about delaying for a further 6 months on average. Returning to our point earlier about US household wealth, well, you see that as US 10-year rates went very strongly negative, so you had a big expansion in the PE ratios of US companies. And now, as real rates are rising, so those PE ratios are coming down. And if the historic relationship on this chart holds, then the PE ratios have further to fall. And Richard's point, that means wealth has further to fall. And this is another way of showing that chart. So on the y-axis, you have inflation. On the x-axis, you have the cyclically adjusted PE ratio. And right now, they're nowhere near the historic relationship. They're too high. So
substantially too high, Keith.
Yeah. It has to shift left a long way to get back on curve, which means PE ratios falling, halving from where they are.
That's not nice.
And this is Hang Seng, which has had a bounce on rumors of an end to the zero COVID policy. Now, turning to the Q3 earnings season in the US, and see that the earnings have been disappointing, although the market doesn't seem to care and has been rising the last few weeks. But 70% of companies beat their estimates, although you notice the red bars have been rising, which shows 25% have actually been missing them. But the overall picture is one of US earnings which are well above trend. And as we head into recession, we expect that to fall back to trend and below it. And this is 2023 forecasts. And you see the consensus has been falling. So analysts have been cutting their 2023 forecast, but Deutsche Bank's estimate is right down here. So they haven't been cutting them fast enough. All of that means further downward revisions in the future and further sell-offs in the S&P 500. This is the earnings of Exxon in orange. The bar at the bottom is Amazon, Procter & Gamble, and Tesla combined. Oil is unfashionable, but hugely profitable. And going forward, I think this is true. I think we now have to shift from technology and growth stocks next cycle it's going to be value stocks. So fuel, agriculture, aerospace, nuclear, and gold.
I just say,
guns. We need guns in there.
That is music to my ears. So the only one that I'm not either invested in a small way, or at least in a small way, or a larger way, or not interested in, is aerospace.
Yeah, actually, yes, you're right. Actually, aerospace, we have a stressed consumer that may well not work. Well, that should be a defense, I'd say.
Yeah. Fighter aircraft.
And on to commodities. Now, this is base metal stockpiles at the LME. They are low and falling. So visible stockpiles of base metals are very low, which suggests a tight market. Pause, take a look. This is how many new mines we need to meet battery metal demand for electric vehicles. Essentially, we need loads of new mines. It's just unlikely.
I think Greta Thunberg is now endorsing nuclear power, isn't she?
Good.
Remarkably. I had a conversation with an oil protester on the South Bank a few weeks ago. And I said to him, you know, what you're doing is pointless. We need nuclear power. And he said, yes, but it takes too long.
So who's going to starve in between?
That was my point, really. I said, well, we're going to see complete economic collapse, complete societal collapse.
Yeah.
I think, I don't know.
Yeah. Let's not get started. So anyway, turning to energy commodities. Big week. Brent up 0.5%, WTI, which is US, up 2%. But in Europe, natural gas rose 17%. In the UK, it rose by 44%, bouncing back. So now both European and UK gas prices up 80% on the year. Now, they remain well below their peak, and we're just getting into a cold snap in the UK, but obviously nowhere near as cold as it's going to be in January. In the US, natural gas futures rose by 6%, but remain very low, actually, compared to their peak, which is surprising. Coal had a bad week, down 8%, still up 108% on the year. Uranium faded down 4%.
I'd just like to say that I think uranium is an opportunity to fill your boots. Did you see that Canada is spending $900 billion on restarting its nuclear program?
Yeah, the trouble is, Richard, that's all going to take many years. Now, moving on to data specific for the oil market. Well, we had further drawdowns in the US last week, including the SPR. There's an inventory drawdown of 2.6 million barrels and private sector drawdown of 700 million barrels. So you'll notice, actually, there's quite a small release from the SPR, and it wasn't enough to satisfy total demand. The US total crude production fell by 100,000 barrels on the week and is now 11.9 million. It started the year at 11.8. So we've seen oil prices are high and rising, and there's just no response from the world's swing producer, US shale. The Baker Hughes rig count actually fell by 2. So this is Brent, which has bounced from its lows, and that looks like a new uptrend. And if we look at earnings, well, oil companies are doing just great. The question is, as we've discussed previously, is as the US economy goes into recession, the world goes into recession, how much will demand fall? We know supply is tight. These are EU natural gas futures bouncing off the recent lows, but still well down from their highs. UK natural gas futures bounced hard. US natural gas futures, you would expect as the Freeport LNG liquefaction facility comes back online in Q4, that demand to rise and this gap to close. There's a huge discount now between US natural gas prices and European ones. Coal prices are fading. Uranium has had a bad week. And on to industrial commodities. Now, a mixed week, but some big falls. So copper was up 1%, but iron ore was down a further 4.5%. Reminder, last week it dropped sharply and that fall continued this week. Lithium up 106% on the year, still rising. Neodymium faded. Nickel had a bit of a bounce. Tin down 50% on the year, down another 3.6% this week. Ferrovanadium had a bit of a bounce, up almost 4%. Zinc fell 7.5%. So mixed, generally a downward trend, I would say. This is aluminium. Has that found a bottom? Reminder, lots of European smelters are now offline. Cobalt flat. Copper seems to have found a bottom. Copper inventories very low, but they have risen over the last few weeks. Chromium flat. Iron ore, no, that's not good. That seems to be a definite downwards drift and suggests that the Chinese construction sector ain't doing too well. Lithium steadily rising. We have a structural shortage of lithium for EV batteries. Neodymium, this bounce seems to be fading. Nickel flat. Tin continuing to drift off. Ferrovanadium going nowhere. Zinc downwards drift. And onto precious metals. Now, the rise in interest rates this week meant that gold was down slightly, down 0.6%. Silver bucked the trend, up 1.9%. The rest of the complex was all down. We showed you earlier how vehicle sales were not recovering post-pandemic, and so rhodium has drifted off. This is gold. Actually, it's not fallen as much as you might expect after the Fed stated that interest rates would need to rise further for longer. Interesting, in Q3, central banks bought a lot of gold. So central banks are shifting away from holding each other's bonds and currency to holding their reserve assets in a hard currency, i.e. gold. Silver had a bounce. Platinum, rhodium drifting off. And if we go into recession, then rhodium can be expected to fall further. Rhodium's main industrial use is in catalytic converters. Palladium. And finally, onto rates. So we had big base rate rises in both the UK and the US, and surprisingly, in the UK, short rates fell, presumably after Andrew Bailey stated that he wasn't expecting UK base rates to have to rise much further. The long end, they rose slightly. But the big action was in the European periphery, where rates rose strongly, the 10-year. So Greek 10-year rose by 33 basis points on the week to 4.7%. The Italian by 43 basis points to 4.44%. Now, if they just stay at those levels, Italy's in trouble.
These are 10% increases as well, Keith. 10% change on the week.
Yeah. This chart shows the 30-year real yield. And only a few times in history has it been negative. So either CPI, US inflation, has to fall back, or the 30-year has got to continue rising. So this chart is essentially saying it is too early to buy US long bonds until we see a convincing turn in inflation. But investors have actually been big buyers of US bonds. So they've been buying bonds, they've been selling US treasuries, data to August. This is the UK 10-year, which is off its highs after the mini budget fiasco, which is good news for UK mortgage holders. So the 30-year, it's stabilized. Not sure it's going to come down further yet. It's a US 10-year. You'll notice that the US 10-year is yielding substantially more, 60 basis points more than the UK 10-year. This is German Bunds, 2.2%. Italian 10-year yield, 3.4%. Greek. And finally, onto the seasonality chart. And we're in bear market, and they tend to have an October bounce and then fade into November. And we're entering November. So concluding comments. Interest rates continue to rise. Economies continue to slow. And that is a fatal combination for risk assets. Stay cautious. Richard, what have you been up to this week?
My portfolio is still very quiet, a bit like my voice. I was inactive in the last week. I am considering the right point to buy some Wisdom Tree Industrial Metals ETF. I noticed that it seems to have got a point of support here. This is a weekly chart. It's also noticeable that it's fallen almost 50% from its high, probably 40% from its high back at the beginning of 2022. So I'm wondering. I'm convinced that at some point there will be a time to move back into industrial metals. So that's on my radar. A few little charts on gold. As everyone knows, I have a lot of physical gold ETF holdings. Emphasis on the word physical gold ETF holdings. This is a chart that shows how gold has done in different currencies in 2022 year to date. And the UK is actually at 5.4% now. Japan has done extraordinarily well, 15.4%. And the US dollar gold is down 10.7%, which is the chart, of course, which we always look at. But it depends very much on where you live and what currency you're investing, you're using, what your base currency is. Now, Keith referred to the fact that central banks have bought about 400 tons of gold in the last quarter, which is extraordinary. And almost unprecedented in recent times. And this is a chart of gold deliveries off the COMEX. So the COMEX is typically a small delivery or non-delivery market. And since the last 18 months or so, it has become a delivery market, which means people are taking physical gold off the COMEX. And which is a change of behavior. And this is physical silver deliveries off the COMEX. And again, you see this is a change in behavior. And this is a graph of the commodities total return against the S&P 500. And what it suggests, I should say, is that the commodity return versus the S&P 500 is extraordinarily low, and probably not going to remain that low for so long. Whether it's connected by the S&P 500 moving or commodities moving, or a combination, of course, is the big question. My view is that there's a possibility that central banks are setting up for some form of to protect themselves from some form of currency reset outside to move from the entirely fiat currency system into some sort of commodity, not a gold standard per se, but some sort of commodity backed system. And that may or may not be the case. But in either case, in the UK, at the moment, you're getting a fairly decent return on gold. And I'm just sticking with my strategy.
Yeah. Interesting. Very interesting, Richard. It's actually gold has turned out to be a decent hedge. Certainly much better than equities or bonds this year.
Not as good as oil, though, Keith.
Yes, absolutely. But the question really is, we generally gold tends to do badly in a sharp market sell-off. And if you think about the great financial crisis, when the big falls in equities, people had to sell their gold to fund margin calls, and gold fell 30%. But what's been really noticeable about this market sell-off is just how orderly it's been. And so there hasn't been a big sell-off in gold. But I worry that if there is one, gold will fall as it always does as correlations go to one. And at that point, gold would definitely become a big buy.
Yeah. I mean, you may be right, Keith, and it's very difficult to know, isn't it? And I think it's in this market, you are either a trader, which I'm not, or you're a long-term holder. It's very difficult to be something intermediate.
Yeah, very true.
How was your week, Keith?
Well, I had an okay week, actually. So I was up 1.3%, which takes me to 23% on the year.
Very good.
Essentially, I still have half my assets in US dollars, and obviously sterling fell sharply, so that was good for the portfolio. I had no sells. I added a small amount to my PIMCO cash ETF, but essentially I've got half my assets in US dollars, half in sterling currently. Now, talking a bit more about this PIMCO sterling short maturity UCITS ETF, it has a yield of the best part of 5%. But that means essentially it gains about, let's say, 1 basis point a day on average in net asset value. And I notice in trading it that the bid offer spread is quite variable. If you trade it at the wrong time of day or there's just no liquidity, the bid offer spread can be of the order of 30 basis points. So you would then have to hold it for a month just to be break even as the NAV rises to offset the bid offer spread. Now, I have successfully traded it by putting in limit orders. And so just saying, I'm only going to buy it if it's below this price. And when the bid offer spread, expands, just waiting, putting in a limit order and waiting until it falls back again and then buying it. But be aware that whenever you're trading these assets, you can be killed by the bid offer spread. The only company I want to talk about this week is Rockhopper Exploration, which we covered in Share Talk a while ago and has exploration assets in the Falkland Islands, which it has been aiming to develop for literally decades now. Now, short term, its share price is a function of a legal dispute it has over its former licenses in Italy, which Italy cancelled. And the International Court of Arbitration has ruled in Rockhopper's favor to the tune of, from memory, $160 million plus interest. So when the court ordered Italy to pay Rockhopper, their share price shot up. This week, Italy appealed and the share price has fallen back sharply. Now, frankly, they were always going to appeal, so it surprises me there's been that much reaction, but also that legal disputes last for years. And so buying in the expectation of a short resolution to any of these things is a fool's errand, in my opinion. Okay, that's it. Thank you all for watching. I hope that wasn't too depressing. Please can you press like and subscribe to the channel, and in the meantime, it's goodbye from Richard Wheater.
And this is goodbye from Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.